Can you see my screen, everyone?
I can see the screen now.
Yes.
All right, fantastic. Let's get started. So we're talking about an investor lens, a framework for capital allocation, how you can allocate your capital when it comes to real estate investments. So today's section is not just about promises. We're talking about what has worked. Because this year alone, I've worked with it was this December where I was trying to do cumulative of my investors, and I've seen that we've worked with over 50 investors who have acquired both properties that generate passive income for them, both landed properties and buildings. I'll be like, wow, this is wonderful. There are a lot of people benefiting from this, and I am glad and I'm happy. That's why we're holding this section in particular before the end of 2025. So when entering into 2026, you can have your targets. This is what I want to achieve for myself. This by the end of 2026, this is what I can do. This is what I want. Even this 2025, you can still do a lot. You can still do a lot. Why is my meeting ending? So let's get started. Before you invest in any property, here are 5 questions every serious investor needs to ask. Number 1, the capital required. You need to know the capital you are putting in. How much am I putting in? So what is the total cash you are going to put in this project? Number 2 is time horizon. How long am I going to make my ROI? How long am I going to be seeing profits? Is it in 3 months? Is it in 4 months? Is it in 6 months? Is it in 12 months? Is it in 24 months? Is it in 5 years' time? You need to know your time horizon. The third one is the what? Cash flow versus growth. You need to know the game you are playing. Are you playing the cash flow growth, or you are playing the growth investments? Or there are investments that mix both. You have both. As you're experiencing the cash flow, you're also getting growth. That's capital appreciation. And number 4 is the risk level. Every investment has its own risks. So you just need to weigh the options. If the profit or if the risk level, what you're going to gain is more than what you have to risk, then you can go for it. So, but in real estate, the risk is very, very minimal. It's low to medium. It's very, very minimal compared to any other type of investment. And the last one is the exit option. The last part is the exit option. If I'm no longer interested in this, how can I move out? How can I transfer my money? How can I remove my fund from this to another project? So let's talk about this. So in this project, we're going to be talking about just 2 projects. So we are not too exposed, or we are not too, when at times when there are a lot of things, you just get decision paralysis when you cannot make decision because we have lots of options to pick from. Please, at any time you cannot see my screen, let me know. So the case study one we are going to be using is the agricultural projects. I talked about this briefly last week. So this is a kind of project that holds both growth investments and also cash flow investments. Growth in the essence that you have a land, your land is appreciating in value. And while the land is appreciating in value, you are also getting cash flow from this crop that are being harvested. Some crop can be in 6 months, can be in 8 months, can be in 9 months, 2 years, depending. So you can start harvesting this, and you know that at the end of this social period, I'm expecting a cash flow from these investments. And why using a farming project to hedge against over concentration? Because what? If you have only cash, your cash lose value. If you just do general real estate, you're just exposed to one type, either it's cash flow or it's growth investments, and also a single sector. But with agricultural link projects or farming link projects, you have a diversification. Agricultural exposure, physical land ownership, and also hybrid return on investment, because you are getting your asset is appreciating one in value, and also it combines both cash flow for you. Your return is also there. And why is this agricultural very, very good? I like this agricultural investment in the sense that it has low barrier mode. Because let's be very honest, for you to do an investment that you want a cash flow from it, a good cash flow from it, you need to have a huge budget. 10 million, even 10 million is small if you want to do fractional ownership. 20, 30 million, 50 million for you to get a building. Then you start getting cash flow from it, either through rentals or through shortlets or through commercial leasing. But with agricultural link project, trust me, with 1 million, 2 million, 3 million, you can start earning. You can start earning cash flow. And if you now invest more, like you are doing this on a large scale of farming, you know that your return is also more. So it has low capital entry, easy capital entry compared to other form of cash flow investments. So yeah, we talk about total costs for acquisition now is 3.6 million naira for an acre. And the payment structure, you have an initial deposit of 500,000 naira. You can spread balance upon 4 months, 6 months, and 12 months. And what's the ownership? You own the land. The land belongs to you because you are getting it outright sales. And the structure also allows you without disrupting existing cash flow and facilities scaling over time. We also have short-term crops and long-term crops you can go for, like permanent crops. For example, cocoa, cashew, and oil palm, they are permanent crops. And a well-maintained farm of this can, 25 years, 30 years, 40 years, 50 years. There's some people, this is what they are eating. Even last week, we went to Cocoa Research Institute in Ibadan, and we had to sit with the manager and talk. For someone that has, an hectare of cocoa, received about 11 million naira this year, this 2025, about 11 million naira and just 1 ton of cocoa. So cocoa, oil, cashew, these are crops that are always in demand. And the fact that they also have export value, you can make a lot from it. And these are crops that you plant once. That's why they call it permanent crops. You plant once and you begin to harvest for it. Not like as if you are rebuying the land or, you are replanting or doing all sorts of things like that. So let me quickly do some projections. Can you see my screen?
Yes.
Okay.
Yes, you can see the screen.
Okay. So now let's get to this. This is plantain profit projection. So per acre of plantain, if you buy 1 acre of plantain, your yearly income is about 1.5 billion to 4 million naira, depending on the size of the plantain. You harvest some plantain, they are very big, and a bunch will go for 5,000, 7,000, even 8,000 as off-takers market or off-takers selling price. So if you are going for 2 acres of plantain, you are going to be expecting like 3.5 to 8.5 million naira. 1 hectare is 15 plots. Remember, 1 acre is 6 plots. 2 acre is 12 plots. While 1 hectare, that is 15 plots. You're getting like 3.8 to 10 million. There is always a range in the sense that, okay, the highest and the lowest. Do you understand? So whatever you're going to do, your projected income is always between this variation. Let's move fast. So this one is cocoa profit projection. Cocoa lifespan over 20 years upward, 20, 25, 30. I said that already. A well-maintained, managed cocoa farm has a very long lifespan. And in 1 acre of cocoa, we expected to have like 2 million to 9 million naira, in the sense that this can be turned to value-added goods. It can be changed to value-added products, and you earn money from that. 2 acres, you are expected to get between 4.5 million to 18 million naira. 1 hectare, you're expected to get like 5.5 to 22.5 million naira from just 1 hectare of cocoa farmland. And this goes to oil palm too. Oil palm, from 1 acre of oil palm, you have to get 2 million to 5 million naira. 2 acres of oil palm, 3 million to 10 million naira. 1 hectare, that is 15 plots, 5 million to 15 million naira. So this is massive. Like, this is a whole lot of things we can achieve. This is cashew too. So now let's move on to this part. We talked about, your farm income, your total return, and also land appreciation. Your farm income provides recurring cash flow years after years. And that's one thing about farm income. You get cash flow years after years. Your land appreciates. And what are the risks in this farming project? The risk is, one, if you are not using a professional hand, because not everybody knows how to farm. So you make sure that you are using a professional farm manager. And that's why in this project, we already have professional former farm managers that have maintained this project in the past over 15 years, and they are still in existence, thriving and doing good, booming very well. That is why we have them part of the team to maintain and manage this thing. So once all these things are in check, you are using a good seedling. The best time to start planning for retirement, you're in 20s, you're in your 30s, you're in your 40s. The best time to start planning for retirement is now. And agriculture is one sector I know. Farming is one thing you can do for retirement. You necessarily don't have to start tilling the soil yourself. You don't have to go to the bush. You don't have to go to the farm yourself to do it. Once you have a good land and a good managing system, the money you are going to be earning, it's even enough to cater for your daily expense. If you are doing a large expense. So what the design for flexibility with this farming project, you get cash flow and also growth. Cash flow from your crops being harvested, and also growth, capital appreciation on the land. And that's like your double growth effects. So if you get farm income and also the land appreciation. So what are the risk level? The risk level is in farming is very, very stable. It is very, very stable in the sense that we have a driving demand. Nigerian population growth is a factor that will drive agriculture, and everyday people eat. These things are what we need for food, for other materials,